Shane Oliver is Chief Economist and also the Head of Investment Strategy at AMP Capital Investors. Shane, many thanks indeed for joining us this morning. First of all, your reaction to the growth figure. Better than forecast, not dramatic, but certainly it's better, and better is better.
Well, in the current global environment, better is certainly better, and Australia is, of course, one of the only countries that has managed to surprise on the upside in the June quarter. So I'd have to say it's a pretty good outcome compared to what was expected, say, a week ago. Compared to what was expected, though, a few months ago, you'd have to say it's fairly disappointing because we did go backwards 0.9% now, previously reported as 1.2% in the March quarter, so we've had a 1.2% rebound. So we've only had pretty soft growth through the first half of the year. Obviously the floods were a key impact there, and of course business investment has come in and stock building has also come in to help drive growth through the June quarter. So certainly a better than expected outcome, a good outcome in a global context, but still not nearly as strong as one might have expected in Australia just a few months ago.
Low unemployment, terms of trade at record highs, a huge investment boom. Do you think Glenn Stevens, as a central bank governor, is handling this well? Should he perhaps changing rates before, or is he doing the right thing by leaving rates unchanged for 10 months in a row?
Well, I think the Reserve Bank was right to be worried about the mining boom, and the strength there is clearly coming through because business investment was a key driver of growth in the June quarter. That said, though, when you look beneath the hood, you do see weakness in the rest of the economy, particularly in consumer spending or retail sales and in housing-related activity. And the danger is that the turmoil internationally will adversely affect Australian consumer and business confidence. In fact, it already has. Australians have seen a loss of wealth. All of those things, I think, could be a bit of a drag on consumer spending going forward. So whilst the Reserve Bank has been right to focus on the mining boom and the strength coming through there, and that's justified rates going higher up until about a year ago, I think the environment is now changing, notwithstanding what we saw in the June quarter. My feeling is that by the end of the year, the Reserve Bank should actually be cutting interest rates as that weakness continues to come through in the non-mining part of the economy.
Now, Shane, one figure that's very important to Australia is, in fact, the Chinese inflation number on Friday. Again, how crucial is now the Australian-Chinese trade relation?
Well, that relationship is critical, and if you think back to the global financial crisis, Australia was about the only industrialised country to avoid recession, and part of the reason for that was that we were about the only industrialised country that had positive export volume growth over the 12 months to June 2009, and that was because Chinese export volumes or demand for our exports held up very strongly. And so therefore that relationship with China is critically important. What is going on in Europe and the US is of interest to Australia, certainly affects our share market, but in terms of the real economy, it's China which matters. If China holds up, which I think ultimately it will, then that will help Australia come through this period of this latest period of global turbulence in reasonably good shape. But if China has a hard landing, then obviously Australia will face a far more difficult time.
Shane, thanks for joining us this morning. Shane Oliver there, the Chief Economist at AMP Capital Investors, joining us from Sydney.